We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is the market sniper himself, Francis Hunt. He's a CMT in technical analysis and the founder of themarketsniper.com. How are you today, Francis?
Very good and delighted to be with you again, Tom.
Excellent to have you. I always look forward to our conversations, even though sometimes they might come off as less of a conversation, but it's always good to speak with you. And you've got some interesting, let's say, inside baseball, telling us a little bit about some of the changes that have been occurring in physical demand, right?
Yes, very much so. So you know me as the guy who's macro and chart orientated. And to some people that's interesting, but a lot of people also like narrative and a bit of fundamental information. And I value that too. And I think you might find this interesting. This is from across the pond. This is the UK. And this came from a particular gold company that we work with as well. This was a kind of a press release of information and statistics that came from them. So I'll read a little bit. I don't like generally reading, but this is important and it's verbatim as we received it. The Pure Gold company has seen a 618% increase in financial professionals purchasing physical gold and silver coins and bars over the last month compared to our monthly average of the previous 12 months. So this is in the UK. They're based in the city of London. And basically what they're saying is the financial professionals, the people who have their fingers on the pulse regarding various things, are absolutely jumping ship. So it was Josh Shaw, CEO of the gold investment, said over half the clients currently investing in gold work within the financial sector. That's banking, insurance, or accountancy typically. The extreme market volatility, both in equities and property, along with systemic counterparty risks that may come as a consequence of that, are key motivating factors in their decision to purchase gold right now. Some bankers have even expressed concern about the banks they work for. This is inside knowledge on the people that are employing them, reflecting a trend of financial professionals with insider knowledge of the banking industry, moving some of their assets away from that industry into the good old barbaric relic that's still there in the next morning, doesn't rust, doesn't change property, and it still shines as good as you need it to, even if you have to dust a little bit of the midnight gardening off. So what he's saying is, that's not to say they don't think opportunities won't exist in those other markets, property and equity, but rather that they recognize that it's all about timing, specifically buying after these markets have fallen instead of during its collapse. So in the meantime, investors have become wealth custodians intent on preserving and protecting. It's amazing how those words are now becoming more popular. Preservation and protection rather than everything growth, rah, Facebook, Apple, etc. So they're putting their savings during these uncertain times to take advantage of opportunities when the time is right. Financial professionals understand that whilst gold will not provide a dividend like equities, it does have a track record as a safe haven asset and wealth protector. He goes on to say, one notable observation is a 73% increase in people removing exposure to equities within their pensions. So in the UK, they have a system, Tom, just especially for your US-centric audience, you have your 401ks. In the UK, you can have, and many of the financial professionals particularly have, what's called a self-invested personal pension. So instead of having a life insurance company that decides and has a fund manager and you don't even have an idea of the mix, you could have it all in bonds for all you know, you actually can determine. You can't touch the money, you can't take it out. It's got all the restrictions that go with pensions, your retirement age, etc. Build a lump sum and then purchase an annuity. However, in a bid to try direct it better, you can say where you want it to be directed to. Self-invested. That's the self-invested. So they're known as SIPs. That's 2Ps, personal pension, the 2Ps. So what he's saying on that front, having made that explanation, is a much higher 73% reducing exposure to equities and to purchase physical gold bars within that same vehicle. So people are actually saying for my pension, I'll have a solid gold bar. I'll have a claim on a solid gold bar. In the self-investment person pension, unfortunately, you don't get it sent to you to hold. It is custodian, but nonetheless, they would prefer the money to be sitting there. So it's become very difficult to manage demand and supply in the same way as in previous crises. Certain coins are now very hard to come by, says Joshua. Our buyback guarantee means we can rely on existing clients as a source of stock. And therefore, this has affected us. So one of the things they do is they have a very aggressive buyback. They won't ever pay less than spot. So that's just a narrative from the UK. Of course, the UK was a little bit in the news and was maybe a bit more schizophrenic over the last month in terms of what was going on. Essentially, the Bank of England, for Americans that haven't been following, had to intervene and support the bond market due to low liquidity. Some of you might have also heard that the Bank of Japan was having no bid periods and trying to hold the market at a level. So what you're actually seeing with all this proliferation of debt that's supposed to be worth all so much, there's an absence of buyer, and the central bank is having to come in and say, we'll be the buyer of last resort. And that positions them, in my worldview, as toxic bank. Because at the moment, everyone should realize that we are on a debt-based economy, and the current yields being paid, and the UK is a full percent behind the Fed, that's Bank of England, at 2.25 versus the current 3.25. And as I often say, money flows from those who value it least to those who value it most. So you can give an untrained person, a ne'er-do-well type character, a lottery winning, and that money will dissipate to all the service providers that will provide all the toys he'll buy during that period. And in the same way, at a central banking level, if the Federal Reserve is tightening faster and the dollar is still the base currency of the world for now, even though there are moves afoot to undermine that, if they are tightening the rates more and the currency is firmer, and we've had a dollar dominance theme, and the Fed is showing the intent to maintain that, what happens is those that have treasury functions in big corporates, and even those that have dual citizenship, will rather hold their cash in dollars and earn a better interest rate where the currency is appreciating against other currencies, than sit in ones where it's less well respected. And savings the savers have been the people that have been killed for multi-decade. Mm-hmm. And largely, the central banks haven't cared about that. They've been in an expansionary proliferation model. Now, people are comparing relative valuations, and currency flows will go where they treated best, and you're seeing that. But the eventual stopgap is, of course, the precious metals markets, because many of the things that exist and the problems that occurred for the UK can also be replicated in the States, because you also have a lot of big corporations heavily invested in bonds. We've been short the TLT, which is the ETF of long-dated bonds, for an extended period. We were calling the top on the bond market, and it was our very first call. It's not something we've done every season on the basis that every 12 hours or 24 hours, you're right. It was our first call when it was very, very high up, back at 165, that TLT. It's now traded through 100 to the downside. And remember, that's a big deal. Bonds are boring and slow, supposedly. Mm-hmm. We called the FX markets to become the new crypto markets, and that has a direct bearing. FX and debt overlay, because the comparisons of indebtedness and the yield paid on that indebtedness is seeing flight capital coming out of Hong Kong. We called the Hang Seng short and said there's a lot of flight capital. This has caused a lean on their peg, and that's been bumping up against the rev limiter. Eventually, that engine blows, in our opinion. We've called for a peg fail, and you're seeing the same in South Korea and, of course, in Japan. So those equity markets have weakened as foreign capital is being sucked out, and that also means not only in that asset class is it being sucked out, but it's also going into the better currency. So money is sensitive, and a lot of the money is global. The really big and the real wealth has a global macro hedge fund view. They can choose where they have it. You don't have to be a high net worth. People will have maybe a pound and a euro and a dollar-based account, but this is all about corporate money. And that's where the big money is. You only have to look at Apple's cash reserves to understand this. So if you're selling apples in Japan, devices, you are repatriating those profits quickly on account of A, you're getting no interest in a Japanese bank account by leaving the profits there, and you're getting a currency effect that's being killed, a proliferation of that currency to support a debt market at a 0.25 yield, where the bank is the primary buyer. So what do you do if you're Apple? If I'm the head of the Apple Treasury, I'm bringing it to good old American pie. Home is as sweet as it gets, the US dollar.
So, Francis, there was another piece of news that came out of the UK about the perpetual bond. So how would that work? And is that more a symptom of the times?
Oh, absolutely. So you're right to bring this story up, and thank you for that prompt. So in the Financial Times, which is known as the Pink Papers, it's almost sort of this. I'm wearing my transgender pink shirt in honor of it. It's almost this grand old grandfather of stern, real gravitas financial reporting. How much you should take that seriously, I don't know. But Mr. Soros, no less, writes an open letter. When people write open letters, this is preaching. This is prognostication. If you really want to give some quiet advice to a central banker and you're a multi-billionaire that happens to make a lot of that money shorting the pound and not giving a rat's ass, if you'll excuse the phrase, about British economics and the effect that had on the British people, you don't write an open letter. Writing an open letter has a speaking to the crowds and a prognostication type tone. And in it, Mr. Soros was making a claim. Officially, it was addressed to Rishi Sunak, who's now the new prime minister after the other one was deemed not fit for purpose and just went in one turnstile and straight out the other, along with a treasury minister. He was saying what you should be doing is, because of this absence of bid on the debt, is rotate some of this debt into a long-form debt, so long that it never actually gets paid, a perpetuity bond. And now, essentially, that means if you had a 10-year debt and a 2-year debt, what you do is you roll it into an open-ended bond where you only ever pledge to pay a floating rate on it. So this is a bit, and just to parallel the significance of this, this is a bit like I came to your hometown. Let's say you were Houston or Dallas or Vegas during the property boom and then the subsequent bust. And I said, I tell you what, let's take everybody's mortgages, and instead of having a capital repayment or putting aside money in a vehicle to pay off the capital, we just flip all those payments into an interest-only payment, and you never have to pay your house off, just service the interest. So that I reduced everybody's mortgages so that they could feel good and wealthy again. But of course, they never get to pay the end property ownership. What am I doing? I'm providing a more debt to an already over-indebted situation with ever more flexible terms. I'm not sure if you recall, on the perpetuity, prior to the perpetuity, in Euroland, I think it was Austria, it could have been Switzerland, I think it was Austria, they released a 100-year bond. And that has been an outrageously terrible investment, because it was a 100-year bond that was barely paying a positive coupon at all. So this is about as high priced as debt could be, because you've got to remember, in terms of yield curves and longevity, the further out the yield curve, just lean out the picture there to point upwards, the higher the rate should go. Because when you're compounding many times interest, the cost of inflation, even low inflation, compounded over sufficient years, seriously erodes the capital value. In other words, $100,000 today is not what $100,000 was 30 years ago. You don't buy a good home in America today with $100,000. 30 years ago, you probably bought an unbelievable property and had quite a lot left over for all sorts of other luxuries and goods. So this is the effect of compounding of the loss of buying power, which is inflation. And so all central banks are inherently inflationary. In other words, they are proliferators. It's just the rate that varies. And part of their message highlights this. A little bit of inflation is good. Deflation is so dangerous. What's dangerous about the buying power of your money going up? Mm-hmm. Tell me, apart from them and the fact that you pay less, and you actually need less salary, and in actual fact, you don't do bracket creep into higher tax bands where many of these nation states have marginal tax. It's very good for you, not so good for them. Remember, they are an adversary. They do what's good for them in controlling you. And they preach that message as if you should want the same. Meanwhile, you are wishing for your own undermining and lack of sound money principle. So that's quite a long answer to there, but we covered perpetuity and 100. So Soros's solution for British's travails is actually more debt, which never gets paid. And of course, that would be a floating interest rate. And that would be in a time where we are, in our technical opinion, are calling a reversal in valuations of debt and an ever higher yield, although we can't go too far before we go into an entire system failure. So at the top of the market, where it's now retreating, it's a great idea to be issuing debt because it's probably going to be jubileed out. I want to be a seller of debt. I don't want to be a buyer, in my personal opinion. And what Soros is applying is do a patsy scam sale. Just don't be the buyer of it. Just sell more and keep stuffing fools. But are there enough fools to now volunteer to buy perpetuity bonds, especially given the 100-year example, which at least you get your money back in 100 years, which if you have an entity will go to your heirs or whatever the case may be. So that was the story there. And that just made me laugh because it's just a case of more debt on top of debt on ever more flexible terms. It's a bit like you fixed the Argentine government and the Argentinian peso by lending them more because they cocked it up the first time, as if you're going to get a better outcome this time, and saying have more for longer. And just ride the floating rate, which of course, in our opinion, is going to go up and become less affordable as you go. And you're never paying capital, so that owed amount's going to kick around. That's where we're at.
So wouldn't the argument against deflation be what that does to the economy as well?
Would the argument against, did you say inflation or deflation? Sorry,
deflation.
I didn't hear you.
Deflation.
Yeah. So deflation, in my opinion, will occur only when you have a disorderly contraction. In fact, we are kind of experiencing that to a degree inside an inflationary. So we coined the term hyperstagflation. I don't know if you recall, and that is actually two mutually rather negative forces going on. So it's stubbornly high inflation at a simultaneous time as very weak and lowering growth, truly. And we feel that this is going to be, the hyper applies to the combination being at an extremity. And this is the reverse Goldilocks economy, where actually we had very low inflation and extremely high growth. In other words, they were able to proliferate and cause asset booms in the dot-com period under Greenspan and then the subsequent property boom on account that we were offshoring globally to the lowest manufacture point, cost of input point, which was often driven by very cheap labor, where there was no unions, poor working conditions. And we got this boon, which actually said inflation stayed stubbornly low. Greenspan thought he cured it. And that was the Goldilocks economy. He hadn't cured anything. He just expanded or allowed corporations that found their way themselves to outsource beyond the US borders. And what that did is it took manufacturing offshore, which has hollowed out the economy to some degree. Retaining some blue collar and some manufacturing is critical. Now, the UK is the most extreme example of that because they used to mine and they used to manufacture. When I was doing apartments and we were participating in the property boom era, we had all these apartments called the Hat Factory and Macintosh Village and all of this. These were places where Britain made for the world hats and Macintoshes and boots and the Candlelight Factory and all of these things. You had all of these places that to manufacture. There were industries that died, often near rivers where they were, they would be picking up some water and dumping a bit of pollution. Britain had bad air and they were manufacturing. This is in places like Birmingham and Manchester, et cetera, and all these brownfield sites that had failed due to manufacturing being outsourced and taken offshore ended up now getting repurposed as residential living, buy-to-let, and was part of the next boom, the asset price boom. That was everyone becoming a small landlord with a number of apartments, which is a bit like the Miami condo flipping element that was part of the 05, 06, 07, 08. So in your question, you are asking, will we get this deflation? We are, in terms of growth, already going to be capped. We're going to have a stubbornly low level of growth. And we're going to have a stubbornly high level of inflation. And this is the worst combination for the retail market. It's very good for the billionaire class, because if you have huge debt and you've been able to borrow massive amounts at low interest rates, because banks would rather move an entire block of money to one mega client, especially if it's got a inherent too big to fail label to it. It's much easier to manage with one big corporate guy than do lots of SME loans and face the real risk of bankruptcy on these smaller. So we have this inherent bias in the banking system, which makes it far more easy to manage. Branches don't do loans anymore. When did a branch manager ever make a decision about a local businessman? All of this gets sent to head office and refused, and a couple of billion go to GM or IBM instead of borrowing about 100 grand here and 50 grand there. So what we actually get is all the capital gets pushed up cheaply because they get big blocks. So the cost of administration is a lot lower. It's only one contact point, and they get beneficial. So during the period of negative real interest rates, those corporations, their debt is actually reducing in terms of its buying power. And they've been paying artificially low interest rates on it in an environment that it's reducing at quite a fast level, officially in the 8% in the US, in the 10% in the UK, and the 11% in Germany, but probably unofficially quite a bit higher. So that spread differential between what those mega corporates pay and what inflation truly is how fast they devalue their debt while securing income producing assets or tangible assets that you could not compete to buy for because you do not have the same access to that level of capital nor at the same price. So this is the corporatization of America, and this is why disinflation for us, real economic hardship in an environment where interest rates are stubbornly high on borrowing, and many people are using credit cards, some of the most expensive debt, and paying 16, 20, and even 29%. Generally, there seems to be an unofficial 30% is deemed excessively usury. But let me tell you, you don't want 20% compounded against you in an environment where you're not getting that growth on anything. Your share portfolio is down. Your bond portfolio and your pension is down. If you've been put in such instruments, everything is largely down. Even Bitcoin's down, and the paper price of gold is even a little bit suppressed itself.
Well, when you're mentioning that spread differential, and you mentioned the paper price of gold, you were recently talking about wanting to actually start kind of making a physical price of gold and silver. So how big do you think that spread could get at this point? And would you include those premiums?
I'm seriously considering it. If there's a student out there with some time, I'd happily have one of my people have a discussion with him. Essentially what I'd love to do, this is a theoretical idea. And let's have the guys comment on your video if they'd like to see this happen. Please leave a comment here on Tom and the channel's video if you'd like to see this happen. But I'd like to take an aggregate of reliable suppliers, maybe a UK supplier. So we could take Pure Gold, for example. You have a couple of interesting relationships with guys that deal on the institutional side. Tom, I think you said Ottawa. Give us the name there. If it was
Idaho. Yeah, Idaho.
My apologies. And we know Scottsdale Mint, which is Arizona, that would keep the US guys on side. We could have a portfolio of providers of precious metals, and we could take a gold ounce, or maybe we want to take a tube. We don't want to have it too scaled, and ask how much does it actually cost a retail man to get 1 ounce of gold or 1 ounce of silver practically delivered to him every month. And we could take it down to a daily price, which would include a delivery charge. Now, I know above a certain size, you'll get free delivery. Maybe we have to think, what's the logical size? Is it just an ounce you're buying? That's kind of a little bit, maybe a bit small, but we get a true price plot. So it's not only the spot price that you get off the paper COMEX market, but it actually any premiums in that exist. So when it goes down the spot, does that premium stretch a little bit? Any delivery costs that are going up, because of course there's oil, there's plastics, fantastics, there's all sorts of things. A lot of that goes into it. What does it cost me to get an ounce? And I would plot that as your nearer, not unmanipulated, but nearer true price for a gold and silver ounce. And we could have a portfolio of providers. You get a bit of a variance. One would be cheaper 1 month. We could standardize on a Britannia or an Eagle. And on for the gold, we could have a Krugerrand, for example, and we could say this is the true, and we could plot and do technical analysis then versus the paper price, and we could see the premium expand and contract, and also delivery costs where they apply, and that would be a closer to the market. How much does it cost for me to get one in my hand of silver, gold? And I think that would be a different chart and I think it would be a very interesting one. And I think there's a point when that comes that the divergence between my future chart with my portfolio of providers versus paper gold and silver would suddenly diverge immensely. And that's going to be a key moment. And what we could even do, we could indicate that, and we do a one minus the other. And when you get expansion, you could see the momentum. We could do a derivative of the rate of change between the two prices, and we could see when it's accelerating. It could be a very, very useful early indicator because a lot of people think, and I want to caution against this because I'm a technician. I love timing. I always want to know, I want to get in just before it all happens. I don't want to have capital tied up. But on this particular thing, because of providers' limitations, supply chains, other things, the music could suddenly stop before you get it. Many people think, let me know just before it all breaks loose. Then I'll sell some stuff and I'll go long gold. In the meantime, I'm not going to do too much. Paper price hasn't done that much. It's never much more than the paper price. I'll just sit on the sidelines. That's a dangerous position to have, but many are in it. And they just say, let me know just before it explodes. In the real world, people ain't tapping you on the shoulder and say, now's the time, it's about to explode. But many people think, I'll watch when it happens and I'll chase. But the problem is you could have an instant supply chain break and there could be a circuit breaker. Boom. It's just a small divergence. So those people waiting for the tap should actually start dollar cost averaging now, in truth, to get a great average price. That's a personal opinion. Don't try be too clever on timing, because this is not something for which the supply is guaranteed, nor the delivery when you talk about cross-border relationships. Part of our reset planning is get it out of the US. We use Scottsdale Mint, but we have vaulting in Panama, for example, where if you have, the US government come for confiscation, they don't have jurisdiction. You at least have some boundaries and some elements. So people can, get in touch with us if they're interested in that. But I would love to see that price, and I'd love to see that early divergence, because we might be able to get a little bit of a double prompt, and who knows, throw a little bit extra in long and maybe even do a paper trade on it, because eventually to maintain relevance, the paper price would have to try catch up with the Francis actual delivery in hand price. So I thought that was an interesting thought experiment. And if the guys are interested in us taking that further, maybe we can put some resource on it. But that was what I was discussing.
Yeah, and as we're talking about that, I'm thinking maybe we have left it too late to be able to do that, because I believe it was APMEX last week was saying that they were willing to pay, I think it was $10 over spot to buy back any silver ounces. So, we might be
$10 over spot.
We might already be seeing this accelerate to the upside faster than we would have, let's say, even 2 years ago, but especially, let's say, 4 years ago, right?
One thing I'll say is it's never too late to start. There's always a reason why you're late, and therefore do nothing. And no, I always believe in start. You might not be the first, or you might already have some of that, if we can call it a sort of Francis contango between paper price and delivery in hand price. But it's still worth starting, because it'll get more extreme, and at least you will get from when you start data, and it will become a useful benchmark. So I'm still tempted to start, but I need some free labor, I think, or near free labor that will help us work, and we can portfolio to have a call. If someone's interested in being part of that, we can create it and have a good portfolio of providers. And if you get one, that's a bit of an outlier and starts to find it's battling and start stretching it, it'll start reflecting through the entire buy price. And then you might see it goes from 1 to suddenly 3 of your suppliers are actually bidding up aggressively to rebuy. Pure gold won't pay you less than spot. And now you're talking about people offering up to $10 more. So there's pressures. There's certainly supply chain issues that are going to come in at some point, and I expect big divergence on those numbers.
So, Francis, when we think about how gold and silver really come into the market, obviously energy prices affect those costs greatly. So do you think if, let's say, for example, the oil price keeps climbing, that ends up putting some type of a floor under the cost of gold and silver?
It does. It's a very interesting point that you raised. The irony of the pre-COVID market is that we actually did a commodity delta neutral trade, where we called oil to be single digits when it was around $67, and we said at the same time go long gold. And it was one of those rare moments where we'd done a lot of gold divided by WTI, Western Texas Intermediate charting, and we felt that that was going to happen. But as you point out, generally, the correlation is energy is very important. When you need to break big rocks far down in the ground and haul them up to the top, there's a lot of energy and work done. And that's not human muscle power. It's way too much tonnage for that to be the case. So you're using energy, you're burning energy. And that certainly puts a floor under the price. One of the things that's made it easy for silver almost to be artificially disproportionately low, bearing in mind, the likes of Keith Neumeyer and many other miners will point out that you're only getting 8 silver ounces for every gold that they pull out, is that people are already digging the hole for the gold or the copper. And as a result, you are getting an economy of scale when you pull the silver out if it's down there too, which it often in a correlative sense can be. So while you're down there, you grab it. That's a freebie. That's truly a freebie. It's like, you're going someplace to do a delivery, but because there's something else in the other location, you literally only have to go a few kilometers more and you can drop 2 parcels off and you get 2 paychecks. Yeah. It truly is a bit of a unique situation. And pure silver miners are a rarity. They exist, but they are a rarity. And they need really big scale. And they haven't been making sufficient money. And you get certain miners, and I think Keith Neumeyer of First Majestic was one that was actually saying they're not interested in providing if the price is too low. So they start holding back. And if that kind of behavior catches on and they're sufficiently well managed to not be forced sellers just to pay a wage pool, they've got the scale and they can rein back and they have a certain level of automation and they've locked in energy costs and they've done good work. They can stock and they can stockpile and they can inventory build. And that is self-correcting. Many people say, well, the paper price will go down if we have this big depression that you're calling, because we are very bearish generally, macroeconomically. I don't think we can stomach. So here's something on interest rates that's a small sidebar. So allow me this change of tone and a quick point out. You do not get the effects of the interest rates the minute the interest rate is raised. There's a lot of knock-on effects. So if you're on a 2-year discount on your own home rate, for example, Tom, and the anniversary for that 2-year where you're going to have to refi is only in October of next year, you're not affected right now if you've got your discount for the 2 years. What starts to happen is when that point comes, you face a great leap in relative cost. You either go to their standard variable rate and your discount falls away, or you refi somewhere else only to find that the attractiveness of the deals are far worse than they were 2 years before. Because nobody wants to fix rates in a rising interest rate environment. People aren't stupid. The underwriters know, well, we're on the wrong side of this equation. If you want a fixed, well, I have to price in as many interest rate hikes that the Fed could possibly put in, plus the outlook for the economy looking pretty bad, and the likelihood you're more likely to fail because I'm charging you more, and the greater likelihood you might lose your job because industry is going to be turning down. Well, guess what? I'm fixing you here now. And you go, what? That's bloody expensive. Why are you doing that? I can get the variable rate. So they take the variable rate themselves, risk on. And next thing you know, the Fed ups by another 0.75. They remain determined. On that point in the Washington Post, bringing it back to the US side a little bit, you had Larry Summers commenting and saying how badly remembered those that failed to act on inflation were pre-Volcker in the late 70s into the 80s. This is an outrider statement from a very insider type guy on a very Bezos-controlled paper, being given a platform to actually say to the Fed, it's a coded message. I call it almost a wolf whistle, maybe not a dog whistle. He's a bit more dangerous than that. It's almost a wolf whistle, but not the sexy one, the more dangerous dog type variety whistle, where in essence, he is actually coding that the Fed needs to be excessively hawkish, lest their legacy be shown in a very dark light. And those kind of things hold a lot of gravitas, because he's the kind of person who's inside a lot of the inside circles. He says those who talk about things and don't keep quiet and play the game get marginalized. If you want to be powerful, you have to work in the system. He's very much insider cartel, Larry Summers, and has seen the inside of many, many things. And you shouldn't ignore something like that. The Washington Post obviously going to give him a platform, and that's his message. So again, as someone who's reiterated dollar dominance, who said even at 87, 88, we think it will turn here. It's not going to run the previous low, and you're going to see 111 fall on the dollar index. That was crazy talk at 87, and reiterated at 94.5 on an inverted head and shoulders with a double head as the lightning strikes in the background. Did you see that? And so God said. And so as a result, we got a substantial move to the upside, and we've been dollar dominant, and we expect people to be too much on the peak inflation narrative and the buy bonds where diamonds narrative. And they're not seeing that this is a secular end of 40-year cycle, which is actually embedded in an even far larger cycle. The existing Bretton Woods financial system is going to be allowed to crash. We see this as a controlled demolition, essentially, of the existing economy. These interest rates will not be stomached. And the knock-on effect of those rates that have already occurred, so getting back to where I started with all this, is that they're yet to bite in many ways, many people. But they will start to bite as anniversaries go, the longer they are held. So just putting on that amount of pain and holding it there without further increases has a tightening effect ongoing for an extended period. And as a result, further tightening and the knock-on and the leads and lags is going to cause a very harsh reality on many, many things. And I think we're going to tighten into a vicious depression, and more people are going to lose jobs. Eventually, you get to a tipping point. What do you do when everybody's been thrown out of work and is now receiving triage funding of some sort? They call it furlough in the UK. You called it stimmy checks in the States. Well, that's communism. Essentially, how much do you pay a guy? Well, how many kids does he have? Not how much worth is he to society? How much did he breed? What is his need? And that's communism. That's where a brain surgeon on his own was paid the same or paid less than a peasant worker, streeter who had 6 kids. You end up in the Bolshevik communistic state with this technological oligarchy, surveillance finance, where there is such a draconian level of control. And guess what? A bar of gold doesn't spy on you either. Neither does a silver coin. And I quite like that.
Absolutely, Francis. And you guys talk a lot about that on your channel. But something you mentioned was some of these ratios that you use, like the gold to West Texas, for example, or let's say the gold to silver, gold to platinum, something like that. So how do you find those ratios to be particularly instructive to you?
They're very useful. Awesome question as well. I'm going to jump onto the share screen and we can take a little bit of a look. Here's the silver futures. Now, something that occurred today, in fact, that got me commenting in lieu and in light of our forthcoming discussion this evening, was the gold-silver ratio, which is a classic ratio that many people know. Gold was a little bit dopey. I'm going to just switch the lines off a little bit, but we did have quite a reasonable decay in the gold-silver ratio recently. I take us down to a 4-hour, even a 2-hour. I think I actually did a diagram for this. I've got to be careful now. Let's go here. This was the gold-silver ratio I did, and I mentioned this on YouTube. This was earlier in the day. We fell to 83. So the key point about this on a macro level, this is a commodity comparison between two precious metals. We've mentioned that this recent push through the 90 up top here, which was a head and shoulders reversal on this 4-hourly chart, if you can see it, Tom, that went above 90. And there's only really been 3 major modern era poke-throughs on the 90. And the most recent one before this was the 126 super spike when silver capitulated down. I think it was back to 14 in the COVID era. That was March 22. And the other one was a long time before that. So you've had in the modern era around 3 events. So this is extreme undervaluation of silver. We got this reversal in the blue, the head and shoulders, a bit of a rising wedge on the right shoulder, and you've broken down. You got a target in and around 84.75. You made that. We got a bit of a rising wedge in the pink, and you've spilled down. So down is good for gold and silver investors, because this is saying the relative power of silver is now climbing to gold. So where you previously needed, you get 90.5 ounces of silver per ounce of gold, you're down to 83. Listen, it's still chronic. It is still exceptional. This is not a normal level of ratio, even at 83. I think that's softened a little bit today. It's gone back up just sub 84, 83.9 on this chart. Let me just push that. A little bit of a rally here after that. But this is a good breakdown, and there was that head and shoulders. It's a good breakdown, and it's just showing that for now, we've certainly overextended against this. And this is giving a little bit of, this could have some of the, there's been a lot of talk about the shorts and the lack of silver cover at LBMA and COMEX as well. And you could be seeing some of this technically in the price. That silver actually has done in percentage terms better than gold, while gold supply can't be taken for granted, but probably a little bit less squeeze than the silver. Then we extended that research recently, and we started to look at the slightly less spoken about metals, platinum and palladium. Now, palladium had a proper rip. Palladium became the star as platinum, often at platinum's cost, because we were pivoting out of diesel engines into batteries and petrol engines, and catalytic converters were no longer taking as much platinum, and they were using more palladium. But palladium looks a little bit more sick, as you can see. This is the palladium price, down at 1870. I say down. Palladium has been a masterful ripper. This is an exponential chart, which actually hides the amount it's gone up. But you could have had palladium in around $143 way back in the 1st of April 03, and now you're at 1870. But this price behavior is not very good right now. So palladium looking a little bit overcooked, but you've got to forgive it a run up from 142 to 1,000. That's literally 12x, possibly, or 11.5x. I haven't got the maths straight to hand, but it's more than 10 times in that time period. And you could have got it in and around 158. That's also over 10 times. That's from 08. That's not that long ago. 08, we're 22. So you're around about 14 years and you've done a 10x. It's pretty spectacular. But what we're noticing now is that platinum, technically, and again, I'm going to make sure I've got the log scale on. Yep, we're logarithmic. Slightly more falling wedge. And when we compare the two, you can see platinum has actually got a little bit of an up, but it's chronically underperformed in comparison to palladium recently. So what I like to do is we do these cross comparables. If you divide the platinum price by palladium, you will highlight that underperformance because palladium did so well. But you will also get a possibility to see how it's looking technically now. And could we see a swing? Is the pain of those years potentially coming to an end? And could we start to see a bit of a turning in platinum? Now, platinum is 30 times more rare than even gold, which is considerably rare in of itself. So in our view, this could, in fact, start to resemble. You can see this relative overperformance recently. Now, you've got to be careful about calling bottoms, but it's our take that you've had a horrific period here. I'm going to maybe just put this on the reg scale because we've got one divided by another, and I think you might even see some technical significance. Going back to the regular scale, and I'll redraw that. What you're essentially seeing is a chronic loss of value, very brutally. Once 5.5, a palladium ounce, you needed 5.5 palladium ounces to get 1 platinum ounce. Now, it's almost role reversal. You need 2 platinum ounces to get a single palladium at 0.5. And this squeezed really, really hard, and you've come out of a falling wedge in their relative valuations. We like a splitter, and you've broken out of that. It hasn't been violent. It's just been sideways. But the suggestion is that this is no longer a relative value dominance for palladium. That doesn't mean immediately that it's a bull market platinum, but you might start to get underperformance. All my life, until only very recent phenomenon, platinum has been significantly more valuable than gold. And I think it should be. But the problem has been the industrial usage, which has dogged it. But it's exceedingly rare. 1/30th that of gold. So if you're getting 8 ounces of silver for every ounce of gold, you're only getting 1/30th of an ounce of palladium for every ounce of gold. So scarcity is huge, and it has some unique properties too. So the question is, does this form a base, and are we at a point where reversal? It's dangerous calling a reversal, but these two are sisters because they're all part of the larger platinum group. But it's kind of like palladium is a strand of its own and platinum is a strand of its own. And you've allowed one to be a super performer and one to be the ugliest dog of the precious metals category. That doesn't tend to last forever. And that could be if you get that moment correct, you might even find for the early stages of any bull market, platinum could outperform not only gold, but even my favorite, silver, for a while, depending on how high it's allowed to go eventually. But it's not typically a monetized. You don't tend to get coins in platinum. You get 1 ounce bars, 5 ounce and 10 ounce, and they're scarce to come by. But just a thought for people that are entering the precious metals, if you wanted to add a third string to your bow, you might get some real, and it's South Africa with power issues, as you saw earlier when we were chatting in the dark, and Russia, where you're having a supply chain bifurcation that say they're now on the wrong side of the fence. So there is platinum from other parts of the world, but those two big juicy suppliers that both sit on the brick side of the fence and have problems of their own. So it could be a very interesting time in that market as well.
Yeah, as you say, when we're at these market extremes, it seems to be always very instructive and seems to be good points to really start to pay attention to if and when those forces start to reverse. But Francis, while we were kind of on the charts there, and we've seen so much volatility in the global markets, you mentioned the pound and the yen earlier. Do you see much more downside for gold at this point, or what could drive that? I had a conversation earlier today about the possibility of Japan maybe starting to sell some of their gold. Does that matter to you as a technician, let's say?
So there's a couple of questions in there. Paper price outlook for gold. Japan selling gold, and then I'm going to introduce something else. I'm going to do a basis of comparisons of mining and mining equities versus the SPY in terms of the asset category as a whole. I'm going to divide the one by the other, which I think you'll also find interesting, and we'll go back to the charts for that. But let's first just talk about, let's start with Japan actually. So far, when it's come for raising money and selling the family jewels, Japan's shown more of a tendency to dump US treasuries because it has a dual benefit. A, they reflate the yen, and B, the biggest enemy in terms of showing their weakness, the dollar, they also put some selling pressure back onto the dollar. So when they are in the seesaw on the low side here, by dumping treasuries, they repatriate into yen, and they also are selling dollars by virtue of exiting that asset class. So they get a dual benefit. It's a bit like if you and I are motorcycle racers in enduro, and if I pull a win over you and you only get a second place, not only do I win the max points for coming first, but I also denied you the max point for first, where when I'm not winning, you usually are. So it's a double header. There's a goal difference element to this. So goals scored by me against you actually count twice because it reduces your strike rate and increases mine. So they're certainly going to do that long before they're going to do precious metals reduction. Secondly of all, the stability of the ruble following their attachment to commodities is almost case study of backing a currency with sound commodities and real value. And you mentioned the credit union that is quite happy to hold gold and do various things as well along those lines. More and more people are respecting and seeing the ruble solution to the financial warfare that was being launched against Russia. Let's not get into the moralities of whether they deserve it or not, but that was their response. And was it effective? It was damn effective because they were in at 160, 170, and now they're back down at 60. So oil and gold backs currency bloody well. So in that environment, do I think Japan will sell gold? I personally do not. I think they'll sell everything else. Remember, they're not a commodity-rich nation. They need to import energy. So I would think even more reason to hold on to the gold that you have rather than be entirely commodity short and having to import everything. And I would certainly see them dumping paper assets. So onward with the treasury sale and hoarding gold, I would see them potentially even use, they might even buy gold with the treasury proceeds, never mind sell any. So that's my personal assessment. Just as a game theory guy, I don't know this. No one's made a statement. I don't have any inside knowledge. Yep. But if I'm running the BOJ, that's what I'm doing. Maybe I'm biased. I don't know. People can make up their own minds. But if I'm trying to survive, I'm not selling the commodities, given the Russian example. The other part is, what is the paper price looking? I'll go back to the screen share and just put us on gold again on the futures side and bring up the screen share, if you'll allow that. Right now, in paper terms, you've had a bit of a rejection on gold. We actually have cautioned at one point that you kind of had an unfortunate, pretty close to similar high in and around the 2000s. We called for a neckline at the classic 1680, 700 line, and you have broken that to the downside. That was a nasty rejection candle. So I don't have particularly good news for you on the paper side of the gold price. Mm-hmm. And that can overall, the gold-silver ratio, we might have another surge up on that. Although silver is showing more relative strength, we can have a look at it at the moment. So far for the month under review, bearing in mind it's only one day, it's not any relevant data. So treating this as a green candle is irrelevant. That's a nasty inverted hammer, and you could see further downside there. And that could, the hypothesis of my depression, that could see the onset of the effect of the interest rates accelerating and coming at us hard, selling off a little bit there. If we just take a quick skip over to the silver, even though you didn't ask specifically for the silver, the silver price, not an immense amount better, but slightly more green. So that could just be that short supply element that has just given it more support. It's also lower. It didn't run as far as gold during the gold run. We're back at pretty ordinary levels of 18, having let that level of 22 go. So I draw a falling wedge with a break to the downside there, but we also had a bit of a passive support at 22 for an extended period there, which has fallen, but possibly a retrace up there. Neither of them are looking immediately ready to shoot the moon, if I'm entirely honest. And if you were looking for very early gains, I'd probably say you're almost better in the platinum idea, but the value of dollar cost averaging during this time is very good. And I think short term, it's not looking excessively exciting, but silver's more in the value basket than gold. However, you've got to remember that this is against the dollar. And as I've said repeatedly, we're in a dollar dominance theme. If you take a look at gold versus the pound, for example, and if you're in Britain, actually its relative position right now versus where it was in 2006-7, let's say great financial crisis over here, you're talking about sub 300 and now 1434. Has it served its role for the British? Yes. What do I think is happening? A lot of localized highs here that have been resisted. That makes for an ascending triangle at some point. You could sell off with the dollar, but I don't think as much against the pound. So you could have a line like this into the future where you sell off a little bit more. We go up for our third visit to this high side, which is in and around the 1580s. And then we break to the upside because we're tapping against the ceiling here for the pound against the gold. And you can see you've been rejected a few times, but you don't go as far down as fast as you did there, and you take a little longer to get down and you try again. And after three impulses, we would expect a break to the upside. So I think there's good news coming at some point, but I think first the depression, then the central bank's response, and then the reaction in the paper price. So I think dollar cost averaging is your friend, and maybe a little nibbling at the platinum market, which is excessively oversold, that might hold up a little bit better if we dip into deep recession / depression. But if you look at it against the yen, the gold price, it's absolutely been doing its job. And again, you're looking very close to recent highs. So in 2009, you would have been barely over 60,000 yen. And right now you're at 244,000 yen. That's more than 4x since 09, or we'll call it 08, the back end of 08. To 22, about 14 years, and you're at 4x over 14 years. Not bad, not bad. You wouldn't say blinding, but pretty solid. So it's really the dollar benchmark. The dollar is getting artificially high on account of flight capital in other places suddenly repatriating back into the global currency. But that isn't a permanent state. And when it goes, that's when you truly see gold go, because then everything in pounds, yen, instead of going to dollar, goes direct to gold. Mm-hmm. And everything that's in dollar also goes to gold. And now everything runs to the precious metals market. I mentioned a third thing that I added to your question, because your question was, how does gold look paper? And my answer was, not particularly great short term, mm-hmm. but it's doing its job against the other currencies. But I could see a sell-off followed by a further ascending triangle. If we look at miners that have been disappointing, and we look at metals and miners, I'm going to pull up the XME, Spider, S&P, metals and mining. We're going to pull that fella up, and I'm going to divide it by the S&P. And this is the chart I was going to show you. So general equities. So we started this interview with Joshua Saul making a statement about his level of business and who was coming. And one of the things he said was financial insiders sold 73% of their equities in SIPs and translated it into metals in their self-custodian. And what you're seeing in the SPY's relative performance is something like this. This might be a one again. When you go long time frames, I tend to prefer log scale. So if people wonder why seems randomly I'm jumping around on scaling, you can do a log scale potentially on that. And you can see it does change the overall look of things, but you would end up slightly less technically significant, I would say, on the log scale. I do like to do both. If I revert back to the regular scale on comparative, I sometimes find on the comparatives, the regular scale is still best. Let me just increase this shot, because this is quite an important one that I want to show you. So this, and to repeat what we're seeing, what you're looking at is miners and metals ETF versus the S&P general ETF. And for me, I think you've got another case of a little bit of falling wedge syndrome and failure to make a new low. And we talk always about three impulses in the wedge. This is something you'll learn. It regularly shows up. A very violent, spiky one is usually your first. That was an awful slapdown. Equities were terrible during the great financial crisis, and the spider rallied. Then they got a bit of a bounce when QE was announced. Then this long, slow death bleed out relative to the rest of equities. Remember, we're doing a relative strength assessment. Mining and mining equities versus the general equity market, the S&P 500. This is your third impulse, which is far calmer, far more low volatility, and pretty flat, and you've walked out of that falling wedge. And again, you're getting a little bit of a chart similar to the platinum core. And that's why I think the platinum could do well, because overall, my view, low vol, very low vol, no more wild swings. Low volatility is often a precursor to an upside move. When you might remember the talking heads on CNN, when they say it's getting volatile out there, it's a euphemism for bear. Mm-hmm. In the converse, very stable, low volatility is often a precursor to an upside break. And you saw an upside twitch there. You did get sold off again, but you could be forming some structure where this starts to be a relative overperformer. And when you think of how much precious metals makes up as percentages of people's portfolios or mining stocks, it's absolutely trivial. There's only upside on allocation there. And as you highlighted, with the cost of energies, the ability to continually to extract at ever greater depths, at ever poorer ore qualities. And Rick Rule will tell you they haven't made major finds in silver and gold in ages. No one should ever call peak gold or peak silver in terms of mining, but it's getting a whole bunch more difficult to find, and a whole bunch harder to extract, and the costs are getting a lot higher in terms of energy. So with all that in mind, I don't think it's out of line to say the prospects are to the higher side on this chart in terms of also the equities in that space, and you're close to lows, and the equities in mining is almost like the platinum chart. they're the great unloved of precious metals.
Mhm.
So if you want to buy a metal, maybe platinum. If you want to buy something that's equally unloved, but you prefer to maybe have a little bit of a dividend, I don't know how much they're dividending. That'll depend on the stock, but maybe you could look at the mining and equity space there. So those are a couple of thoughts for you, Tom, in terms of your question.
Wonderful, Francis. We've covered so much here, and I always appreciate how generous you are with your information and your thoughts. Maybe one thing I'd like to cover before we wrap up today's conversation is some of your thoughts towards cryptos. We talk a lot about this possible debt jubilee, coming central bank digital currencies, things like that. So what types of fiat currency alternatives do you think are going to be allowed to be used, to be transacted in, if and when that occurs?
So the dominance of the existing control structure is going to force all centralized exchanges to comply. And I think we've already seen that in Binance. I think FTX was born that way by being in New York and under a pretty draconian New York crypto regulatory environment where they're very much chess beaters. So first of all, exchanges that are centralized are going to be forced to comply. I think they'll have a plan. I think decentralized exchanges that are non-compliant and don't have this in the ether structure are going to face probably a hacking spree, potentially, adverse events that may be manufactured to cause their downfall on any scale, or some forced regulatory requirement that they'll be able to shoehorn in spite of the decentralized nature. In terms of the control structure, what do they least like? You've got to remember that cryptos have high beta and are pump and dump and fall and have huge moves. Even Bitcoin, it's fallen from 69 to around the 20K mark. That's an excessive. That doesn't challenge. That falls more into a high beta, like a mining exploration penny stock realm, where the normal SEC rules treating it as a security will be more than enough for them to have a lot of control to decide who they prosecute against. There's always a law you're breaking somewhere, and they can pick and mix and control and dominate whoever they think is not towing the line. I think the problems for them are the stable coins. The stable coins offer something that mimics their currency, which is inherent stability. And they're not fond of that. And a key element I will make on stable coins is that because they've had the whole Tether debacle, what's backed, where's the money, and they've kind of behind the scenes shored it up. But they're actually used as security, debt markets, treasuries, which are currently chronically losing value. And we have called very aggressively 2 years ago the debt top of the cycle, and we expect a chronic loss of value in debt, so much so that governments are going to have to buy them to stop rates from going too high. And we've already seen examples of that, Japan being an extreme ongoing example of that. But I expect to even see this come to America too, as people more and more realize you're getting a locked-in negative real yield on something that's losing capital value, as well as giving you a negative real yield. And that's just not an attractive investment. And the proliferation is of such scale. So why would you collateralize a high beta asset against an asset class that's peaked and is losing value in an ever accelerating manner? So this could unfurl, and that could the control structure that is actually managing the descent of loss of this asset class could end up highlighting its own failings as part and parcel as to why a stable coin is no longer properly backed, and use their own poor quality collateral as you've got poor quality collateral. It's your collateral. Yeah, we know it's crap. As to undermine stable coins. So I think stable coins are going to be big in line of sight, because inherently for everyday transaction, an inherent stability, not having something that's lost 20% overnight, 15%, 5%, is going to be the competitor for transacting. Bitcoin is not actually a transacting token at all on any great scale. So this was going to come under pressure, and I expect more attack vectors on stable coins. So if you're talking about the crypto market, those are my comments. There are when we go, and if we are to go in our on balance of opinion into a deeper recession, what ends up happening is that people that lose jobs sell their crypto. They chase the liquidity. And even Bitcoin can sell lower. So if I look at the Bitcoin chart price now, whilst I suspect short term it gets a mini rally because it's been hard sold for an extended period, overall, the macro charts do not look like reversal territory for me. I could see it going to 21.5, 22, maybe between 22 and 23, and coming off back down. You might ask, well, why has it stayed so stable in this price range for so long? And I would highlight, we ran 4 key levels of significance when we broke the 20K level. The 20K round number, the legacy high of 2017, we targeted out on a mega bull flag that was down, and we made a target of a head and shoulders. So typically after a lot of targets being made, you get a lack of progress in your inherent bias of the original move. So we refer to this as a progress decay. Time elapses, so there's a cost of carry, and you don't get further downside. This is not a good time to actively rush in short, but that doesn't mean it's a buy the rallies either, because then you're trading counter trend. This is why it's been a frustrating time for traders in crypto, and it's actually a frustrating time for investors, because investors either want it to bottom or to sell off more. They're just like, I can't bear this sort of purgatory. It's neither heaven nor hell. I think it could go a little higher before coming back down. And I do think a possibility still exists that you could trade in the lower double digits and possibly a single digit thousand in the event of the economic contraction. So this, you raised a question about deflation. Remember when we said hyperstagflation, you are effectively getting 2 events. So you can have global warming and global dimming happening at the same time. Lots of smog and dust in the air that is reducing the heating of the planet. And maybe you have some global warming because there's pollution. I don't know. I'm not making a statement for or against the climate debacle. I'm not ready to get into that one.
I don't know that we have the time for that either.
Yes, you have opposing forces going on simultaneously that almost are slightly contradictory, and it's quite feasible. And can I say the central bank price behavior, my apologies, the central bank's action has been contradictory as well. So the ECB has sought to tighten rates, otherwise it gets hammered at the euro level. You saw the euro run parity. That is something we predicted. We still see it going below 0.85 in time on the dollar dominance, but now it's resting and rallying while the dollar has rested. But they have to up in interest rates, otherwise money flows where it's treated best, as I've highlighted before. This was the big problem with the pound. The Bank of England only did a 0.5 a number of times when America was doing 0.75, and now there's a full percentage point differential between the bank's rates. And they threw the new Treasury Secretary under the bus for his mini budget, when actually they had created an environment where they were paying less for people holding deposits in pounds and incentivizing people to sell their pounds and move into dollars for the interest rate parity that was falling out of kilter and the more aggressive hawkish stance of the Fed. So what we're seeing that is contradictory is that we've seen Britain providing stimulus and supporting their bond market due to an absence of bid, but tightening interest rates. And we've seen this in the ECB as well, supporting the French and the Italian debt markets while talking hawkish on interest rates and we must kill inflation and tightening rates. They actually did a 0.75 recently. So this is what I call the water and petrol solution, where on one end of the fire, you're putting out the fire with water, but you're adding petrol to the other side of the fire. It is absolutely counterproductive, and it causes a problem. And don't underestimate the effect of the tightening that the US is doing, even though it's very small, because in this environment, the Euro land and the UK are actually having to provide liquidity to support overextended and critically weakened debt markets. So there is a differential not just at the interest rate, but at the effect of removing liquidity out of the US market, which again makes the dollar more attractive. And again, we'll see money flows away. So you're getting that contradiction, and that's something. And this is going to continue to drive the dollar dominance long past all the top callers and the peak inflation callers. And a final point on this, Tom, because this is a long form answer, is that it was Volker who said, and I've repeated many times and also stated, as many others have, you don't rein back. There's never in history been a time So this is a categorical fact. There has never in history been a time or a point where inflation has exceeded 5%, and you rein that inflation back with an interest rate that is lower than the inflation rate. And I've done a couple of YouTubes where I talked about chasing on your enduro bike on my unicycle, and I just ain't catching you. You started a day and a half earlier. You're as quick as lightning. You're winning trophies. And I ain't catching you on a unicycle by starting a day and a half later and riding after Tom. The gap gets bigger. You get to Vegas before me. You win the cannonball run, and I come in a very distant last. And that's the game. We've got to actually have, in a real world, to contain this inflation rate, an interest rate that exceeds the inflation rate. And even if I'm on a turbocharged unicycle that's going quicker than your bike, you still started a day and a half before me, not been resting, and you're already halfway through the mid-states, and I've only just left New York. You're still getting to Vegas before me unless I are significantly quicker than you, rein back that differential, and then pass you. And we're nowhere near there. And if we were to go straight there, we would crash and destroy everything and go into a massive disinflationary environment where all debt would contract such amount in valuation that you would have an asset contraction across the board and insolvencies and derivative failures and everything else. So the truth is there isn't the inflation. There is no historical precedent for reining back the inflation at the current levels. Despite the hawkishness, they cannot even do what they need to do to win that inflation game without destroying the economy. And I talk about it being the plank that tapers to a point. You fall off one side or the other. If you keep walking the middle, you fall off both sides. One way or another, you're going over the edge of a precipice, Tom. And the thing that will save you is tangible, held in hand, personal sovereignty, where you have access to true generational value storage. And that is the gold and silver price. And that is why you don't over fascinate about the timing a manipulated market. And I think that's the best place to leave it. And guys want to, contact us, themarketsniper.com, book a call, have a chat. We are specialists in building wealth in a reset environment, and precious metals is going to be a fulcrum, a keystone in that arch that is absolutely essential.
Absolutely, Francis. And like you say, that's, I think, a good place to wrap up for today. Just to add, your Twitter handle is @themarketsniper as well. Francis, thanks so much for your time today. Really appreciate it.
Absolute pleasure. Great to be with you, Tom, and have a great one. I look forward to our next chat.
Absolutely.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.